Today we're focusing on the standard unqualified audit opinion for a public company, also called an issuer. We'll break this refresher into 4 parts. Part 1, the basic issuer report. Let's start with the biggest distinction. A public company is also called an issuer. Audits of issuers are generally performed under PCAOB auditing standards, and the standard clean opinion is called an unqualified opinion. Compare that to what we learned in the previous refresher. For a non-issuer under CPA auditing standards, the clean opinion is called unmodified. So remember, non-issuer equals unmodified. Issuer equals unqualified. An unqualified opinion is appropriate when the auditor concludes that the financial statements taken as a whole are presented fairly in all material respects under the applicable financial reporting framework. The issuer's auditor's report must be in writing, and the title identifies the auditor as an independent registered public accounting firm. The report is generally addressed to the company's shareholders and board of directors, or their equivalents. Now let's move into Part 2, opinion and basis for opinion. One major feature of the issuer report is that the opinion on the financial statements comes first. Think of the opinion section as answering one question. What did the auditor conclude? It identifies the company and financial statements that were audited and gives the auditor's opinion about whether those financial statements are presented fairly in all material respects under the applicable financial reporting framework. Next comes the basis for opinion. Think of this section as answering. What supports the auditor's opinion? The basis for opinion explains that the financial statements are management's responsibility and that the auditor's responsibility is to express an opinion based on the audit. It explains that the auditor is a public accounting firm registered with the PCAOB and is required to be independent of the company under applicable U.S. federal securities laws and SEC and PCAOB rules. It also explains that the audit was conducted under PCAOB standards and describes, at a high level, what the audit involved. This includes assessing risks of material misstatement, performing procedures in response to those risks, evaluating accounting principles and significant estimates, and evaluating the overall presentation of the financial statements. The auditor ultimately states that the audit provides a reasonable basis for the opinion. One additional issuer report requirement is auditor tenure. The report states the year the auditor began serving consecutively as the company's auditor. Now let's move into Part 3, critical audit matters or CAMs. A critical audit matter is an important matter from the audit that meets a few specific requirements. Start with matters that were communicated or required to be communicated to the audit committee. From those matters, the auditor looks for matters that relate to accounts or disclosures that are material to the financial statements. Then the auditor asks, did auditing this matter involve especially challenging, subjective, or complex auditor judgment? If it did, the matter may qualify as a critical audit matter. Think about areas such as a significant accounting estimate with a lot of uncertainty, an area involving a significant risk of material misstatement, a significant unusual transaction, or an area requiring particularly difficult auditor judgment. These are factors the auditor considers when determining whether a matter involves especially challenging, subjective, or complex auditor judgment. Here's an important difference from the KAMs we discussed for non-issuers. KAM asks which matters were of most significance in the audit. CAM uses a different test. Material accounts or disclosures plus especially challenging, subjective, or complex auditor judgment. Don't treat KAM and CAM as interchangeable definitions. Now here's another important exam point. A CAM does not automatically mean something is wrong with the financial statements. A matter may become a CAM because auditing it requires especially difficult judgment. That does not mean the financial statements are necessarily misstated. A CAM also does not replace a qualified, adverse, or disclaimer of opinion when one of those opinions is required. And communicating a CAM does not mean the auditor is giving a separate opinion on that individual matter. When a CAM is reported, the auditor identifies the CAM, explains the main reasons it was considered a CAM, explains how it was addressed during the audit, and refers users to the related financial statement accounts or disclosures. Here's a simple memory trick. What is the CAM? Why is it a CAM? How did the auditor address it? Where is the related information in the financial statements? One more important point. If the CAM requirements apply, but the auditor determines there are no CAMs, the report states that no critical audit matters were identified. Now let's move into Part 4, financial statements versus internal control. Public company questions may also bring in internal control over financial reporting, often shortened to ICFR. This is where I want you to separate two different questions. The financial statement audit asks, are the financial statements presented fairly in all material respects? An audit of internal control over financial reporting asks, is the company's internal control over financial reporting effective? Those are different opinions. For issuers subject to an integrated audit, the auditor audits both the financial statements and internal control over financial reporting. The auditor may issue separate reports or, when appropriate, combine the reporting, but don't confuse the two conclusions. Think. Financial statement equals opinion on the financial statements. ICFR equals an opinion on the effectiveness of internal control over financial reporting. This distinction becomes especially important when you start learning about material weaknesses. A company could have fairly presented financial statements while also having a material weakness in internal control. Don't automatically assume that a problem with internal control means the financial statement opinion must also be modified. Thank you for listening.